So let's chat about one of my favorite loan products. And I know I'm probably not in the majority of people, but I got a presentation. Maybe you've come across this in your life as well. You go to a party and there's a bunch of folks at this party, and all of a sudden somebody whips out a big whiteboard, and all of a sudden you're at an Amway meeting. Is Amway bad? No. But a lot of people think it is because, that which we don't know or we don't understand, we don't like. I kind of reference that to the reverse mortgage world. There are so many people that have so many bad misconceptions that are completely irrelevant, wrong, and ignorant, yet they're the ones out there saying, oh, it's a horrible product. So John Thompson and I think, John, I'm going to speak for you a little bit. We both love the reverse mortgage product.
Yep.
And we both look at it as being, not only for the last resort, but more importantly, as a financial planning tool. Is that fair?
Absolutely. Yep, for sure.
So let's go through. Let's just have a fireside chat. Now, I don't know if you do fireside chats because you're out there in the Coachella Valley, and I guess
the
whole area is like
we're on fire all the time, Ron. It is great. Hey, you mentioned Amway. What about Tupperware? Were you at one of those parties where the Tupperware was suddenly brought out? Like, oh my gosh, now I've got to buy Tupperware. Anyway,
yeah, exactly.
An old reference, right?
Yeah. I think I'm not even sure Tupperware. I think Tupperware went out of business, didn't they?
I think who knows, right?
Yeah, can't really tell, but that. So why don't, before we get too deep into this, John, why don't you just give us just a real quick sentence or two? What is a reverse mortgage and why?
It's just a tool, right? And so it's a tool really to convert, in my mind, what is a non-liquid asset, all the equity in your house, into something you can use as part of your financial plan. Now, everyone's got a different financial plan. We all have different goals. Now, maybe it's building wealth for your kids. You can use reverse mortgage for that. Maybe it's avoiding taxation. You can use reverse mortgage for that. Maybe it's paying for long-term care. You can use a reverse mortgage for that. You need more cash flow. You can use a reverse mortgage for that. So I think it's a Swiss knife of a mortgage, Swiss Army knife kind of tool you can use for multiple different things depending on what you want to do with it. That's how I do it. So
yeah, you made a comment in there, and it's one of the biggest challenges I hear, maybe you as well, but you create wealth for your kids.
Yeah.
And a lot of times I'm hearing that the kids don't like it because they think that's their money and not mom and dad's. So how are you creating wealth for the kids using a reverse mortgage?
Well, the idea of the reverse mortgage is to use that tool to supplement cash flow at times when maybe the market is down. When I talk about the market, we're talking about the stock market, right? So the stock market is down. You don't want to sell your stuff. You want to keep your stuff. You want to keep your things working for you. You want to grow that ultimately, right? So if you can use the money of the reverse mortgage and grow your other assets to ultimately maybe grow your assets big enough where you're leaving more money to your kids by thoughtfully and strategically using all your assets, the house, your stocks, your bonds, all those kind of things effectively with the goal to potentially increase your wealth long-term to give more money to your kids. Your kids typically don't care where the money comes from. Maybe it's the house, maybe it's the stocks, the IRA, maybe it's some island in the Bahamas. I don't know. But whatever it is, they want money typically. They don't want your house.
I chuckle with it. It's just my own personal opinion. Was when I helped my mom and dad get theirs, my sister and I, our comments, we're the two heirs, and our comments were, we want you to spend your last dime with your last breath.
Yeah.
And I've heard so many people say, well, my kids don't like it because they feel like it's their money, their inheritance. And I often say you need to get new kids, because if they think it's their money and mom and dad should suffer and not get to eat, because of this whole scenario, they haven't taken the time to learn it and understand it.
Well, along that same line, and when I have that question posed to me, right, and that's not a problem. I totally understand that your kids want the house or the equity in the house, whatever it is. Maybe they'll pay for all your living for the next 15 years, right? And go ask your kids if they're willing to pay the 8 or 10 grand a month to help you live for the next 15 years, and then see what the response is.
Yeah, that's a kind of turning the subject around quite a bit, isn't it?
Sure, absolutely.
So let's get into some of the things that we hear frequently. The bank owns the house. Is that really the case?
Now you own the house. I mean, nothing changes with the title. If you have your home in a trust, which you should, you own the house just like you do with any other mortgage, even without a mortgage. It's all the same.
Yeah, it's kind of, I find that one to be a very interesting one. Is number one, do we ever, unless you're free and clear, which is, in my opinion, not a good financial planning strategy in most cases.
Yeah.
There's a lien holder, but the reverse mortgage is no different. It's a lien just like any other lien. Nothing different there.
Nothing different at all.
And you mentioned in there that it should be held in a trust. Is that all the time, or how does that work?
Well, I think most people, if they have a sort of any kind of assets, they have family and so forth, putting a trust and a will in place, protects the homeowner from paying tax. Ultimately, your heirs paying tax to the state of California, right? You want to pass along as much as you can to your family and your heirs, right? You don't want to pass along money to the state of California if you can avoid it. So putting a trust in place will protect that. Yeah, and we're not attorneys, by the way, right? So,
yeah, I was just going to say that we're not attorneys. We don't give legal advice. We just tell people, hey, something. If you you have an estate plan, it's either one that you design or the state's going to design.
Exactly. Yeah.
So now the other one of the other ones is, what happens if my interest keeps growing and I owe more than the house is worth? Do I get kicked out?
Not at all. So in fact, it's one of the only products in the entire world where you can actually owe more than the value of the asset and never, ever, ever have to pay it back. It's called the non-recourse feature. It's unique and specific to the HECM, the home equity conversion mortgage. If you owe more money than the house is worth, that money is forgiven. The heirs don't owe it. You don't owe it. Nobody owes it. The house gets sold at a discount and the debt's paid off. And the lender essentially takes the loss, paid for by the fund at FHA, which is part of HUD.
So, that's another one of those really great options in there. People look at it and say, I got to pay all this money toward the fund, and they don't think about the fact that it's like an insurance policy for your family.
Exactly, that's exactly what it is. It protects everybody who's eligible for the program.
So when we come back, I want to talk about that. Eligible for the program. Who's eligible? Who's not eligible? I'm thinking about. Well, I better not say. Well, I'm going to say it anyway. My wife doesn't listen to the show. What if I want to get a new spouse 20 years younger? Can we still? Is there a way to deal with all this? We're going to talk to John Thompson when we come back. We'll talk to him more about that and more about the features of the reverse mortgage. Who, what, why, and why do the financial advisors dislike it so much? Continue our conversation with John Thompson this morning. We are chatting about reverse mortgages and our feeling that we both kind of like this idea. We like the program. We like the product. John, why do the financial advisors have such a distaste for reverse mortgages? Have you been able to learn that over your career?
I don't think I can place my finger on it, but what I do tell advisors and other folks is that at the end of the day, financial advisors, maybe we put them up on some kind of pedestal. The reality is they're just people like we all are, right? So their own built-in biases, they've heard things over their lifetime. They've been imprinted with some sort of story, a money story from their folks, their friends, their class, whatever. So maybe that belief is just something they've heard. It's become ingrained in what they believe, like many other people. They've heard old stories that maybe aren't accurate. They don't know the whole picture. So I don't think that that they hate it at the end of the day. I think they're just misinformed. And there are companies, I think, that sort of, you mentioned earlier, right? So there are companies that literally are searching for email threads that have the word reverse mortgage in and blocking those. And simply, I think they view it as being a risk, right? And so are there bad actors in the mortgage space that sell reverse mortgages without giving education? Sure. But there's bad actors in the financial planning space and in the insurance space and in the estate planning, everywhere, right? It's all over the place. So I do think that advisors who are uneducated around their product just are afraid to talk about it because they don't understand it. They've been taught to believe it's really complicated. There's risks involved. And until they learn what the deal is, they're kind of scared to kind of step in the water, as it were. That's my experience anyway. Yeah,
it's kind of interesting because could you imagine that you've got an account at one of the big brokerage companies, and it doesn't matter which one you think about, and they have a block on reverse mortgages, and you're the client, sending a message to your financial advisor saying, "What can you tell me about this?" And they never see the message even.
Yeah, I tell advisors this all the time. All the time. Put aside your biases, if you have biases, right? Just put to the side. Your clients are looking for solutions to everyday problems, and maybe the reverse is not the answer for that. But if they want to learn about it, they're going to reach out to you. You're the trusted advisor, Mr. Financial Planner or Mrs. Financial Planner. You need to know about it because your clients are going to ask questions, and if you don't understand it, you're doing a disservice to your clients.
Yeah. And, John, before the break, you had made a comment, and I want to circle back to it, about using a reverse mortgage. And you don't really think about a mortgage nowadays as a tax planning tool.
Yep.
Can you talk about that a little bit?
Well, one of the areas that I've been spending a lot of time with recently is using a home equity conversion mortgage to help defer or avoid taxation on Roth conversions. Right. So one of the unique features of the reverse mortgage is that the payments are optional. They're optional. Most people think of it, oh, no payment required. That's fine. But you can make optional payments, and you can not make payments for 3 or 4 years, and then make a large payment, maybe make a $150,000 payment. And guess what happens when you make that $150,000 payment? The lender sends you a 1098 INT, which is a tax deduction against, it's a deduction, and it's going to reduce your taxable income ultimately. So if you strategically do this correctly, you can build up interest over time period using a HECM, do a planned conversion from an IRA to a Roth conversion, and either avoid the taxation altogether or minimize the taxation. Now, you need other people. You need a CPA, you need a financial planner, you need a reverse mortgage expert to make that all happen. But that's how you can avoid taxation, at least in one circumstance.
Yeah, and something, it's a fascinating thing because I've talked to people about that, and they say, wow, nobody ever told me that. And could you imagine somebody trying to get what you just articulated very clearly into a 20-second commercial with Tom Selleck trying to explain that to somebody?
You couldn't do it, right? But if you hear, hey, I can avoid taxation, I'd like to learn more. Great, put your hand up, call a professional, ask them about it. But your financial advisor is probably not going to understand how to do that, to be frank. So. Because
and nothing against the financial advisor. Neither one of us have a problem with that. It's just, it's not their wheelhouse.
Yeah, exactly. That's not what they do.
Right. So, the other one thing that I hear frequently is that, you can't, I'm here in Orange County, California. You've got some very high value properties where you are as well.
Yeah.
Can you do a reverse mortgage with a high valued property?
Absolutely. So, sort of, there's two channels of the reverse, right? There is the traditional home equity conversion mortgage, more commonly known as reverse mortgage, HECM, as we call it in industry. And then there are proprietary products, which have grown in popularity in the last 5 or 6 years, which are really designed for higher value properties up to, I think it may be $10 million or more, and loan amounts up to $4 million and maybe more by exception. So absolutely, we're working on right now. This is about a $2.5 million reverse mortgage on a $9 million property, and it's a fantastic solution for this particular client. But yeah, so it can be done on higher value properties.
Yeah. And something that's a fun one because I actually did one a couple of years back, and it was a very high, I think it was $10 or $11 million property, and they did a $4 million reverse. And
wow. Mom
said she wants to see her kids enjoy the money, but they're going to get it anyway.
Yep.
So
this is a valid point. And when you're talking about taxation, again, we don't need to go down this whole big rabbit hole, but advisors and taxation, the idea of advance gifting to create a tax deductible event for someone in high net worth clients who want to give away their money. Let's just call it one of our, maybe a local school that we both might like a little. Let's call it USC, just for fun, right? And you want 50-yard line tickets. And you know that if I can give USC $1 million today out of my estate, but I don't want the payment that goes with $1 million. I don't want to liquidate my equities. Great. Use your portfolio reverse mortgage, give USC $1 million, get your 50-yard line tickets today instead of when you're not here anymore to enjoy the game.
That would be a great way to do it, right?
Absolutely. Think about living benefits, right? That's what you're talking about. So why not use your assets, right? Living benefits either for your kids or for yourself today, right? Who cares when you're not here?
Exactly. And then there are those people that, have no heirs to give the money to. So in that case, really, why not enjoy the money? I mean, you don't have a plan. You're gonna leave it for your dog, and maybe your dog doesn't need it anymore. But you can enjoy that money and have a good time with it.
Absolutely.
John, when we come back, I want to talk about how much can I get? I mean, if I've got a $1 million house, can I get a $800,000 loan, or how does all that work? We're going to talk about that when we come back. And let's get back to chatting with John Thompson. We are talking about the reverse mortgage. So, John, a lot of loans, especially when you start talking about a HECM and an FHA, and we think about FHA being, the loan where you go with bad credit or challenged times and very, very minimal down payment, 3.5% down. What kind of a loan limit do I have? What kind of a ratio can I get on my money, or how does that work?
Yeah, thanks very much. Great question. So, it's not as much as most people think. The reality is people think, I may get a reverse mortgage later in life, and I got, $800,000 of home equity. I should be able to get all that money. That is not the case. You can typically borrow anywhere between maybe 35 to maybe 42% of your home value. It increases as you age. So the older you are, the more you can borrow. Maybe you get up to 50% if you're in your 90s. But for most people, I tend to tell people, think about 40%, and then of course we'll run the numbers and adjust from there. But 40%, give or take, of your home value.
Okay, and you said
mortgage. If you already own a mortgage, right, that mortgage has to be paid off. So it's not on top of your existing mortgage.
Gotcha. And you made a comment there about it being depending on your age.
Yeah.
So what if I'm going to try and redeem myself? What if I trade down and want somebody 20 years younger? Can we still do something like this, or are we out of the game?
What are you redeeming yourself for, Ron? Were you going to use reverse mortgage to buy a new spouse? I'm not really sure what you were doing there, but that's okay.
Well, we are online, aren't we? I think we can go to mail order.
That's okay. That's good. Yeah. So of course you can trade down, and many people do trade down, right? So we talk to you about trading up, trading down, and so forth. The most common situations when people they're selling. You're in Orange County. They're selling their home they bought for $300,000 is now worth $3 million. They owe capital gains. They sell their house. They buy a house in a less expensive area, and maybe they use the reverse mortgage in that purchase to again increase their liquidity, to create more protection, more cash flow, and more fun in their kind of years when they're not working anymore.
So if I have but what I was looking at there is age issues, and so if I'm 60 and I have a 40-year-old wife,
got it.
Does that work?
It does work. However, the age is going to drop all the way. So you could have a spouse that's not the minimum age for a home equity conversion mortgage is 62, 55 for those proprietary ones we mentioned before, the higher loan limit ones or the higher value property ones. So 62, you can have a spouse under 62. They're just what's called a non-borrowing spouse. There's some different rules around eligible, non-eligible, or ineligible non-borrowing spouses, but your loan limit drops to the youngest age. It's still based on that youngest age. So it does affect how much you can borrow. If you go get yourself a 40-year-old wife, Ron, the amount you can borrow is going to go down.
Oof. Okay, so I guess I better stay where I am. Talk about fees, John. Are these real expensive to get started, or how does that work?
Like any product, there's going to be expenses, right? And so the expenses are threefold. There's the insurance, which we talked about a little bit before, that protects everyone in the program. That's 2% of your home value, up to about $1.2 million, give or take. And this is again specifically on the HECM. So that's the largest kind of cost line item. You then have just the normal transactional cost. You have an origination fee to the lender. Then you have the cost of escrow, title, appraisal, credit report, those sorts of things. So yes, there's fees involved, but you look at all the different things that are going to happen with that product. And sometimes people get to me and go, that's amazing. It's just way too good to be true. And it's not necessarily way too good to be true, but it is way too good to be free.
And there's no free lunch, right? I mean, it's right. There's a lot of people that are out there serving, and they've got to get paid for what they do. So it's a good deal. Yeah. Now, does that mean that the borrower has to write a check for all of those fees, or how does that work?
In most cases, people put it into the loan amount, like when they're doing a refinance of a mortgage from one. Let's just talk about from one mortgage to another mortgage. You tend to wrap the fees into it. You don't have to, but most people do tend to do it that way. And I want to go back and just be clear, because where it doesn't work for some people, because the fees are there, There's expenses. It's not a short-term product. This is a longer-term planning type of product. You don't want to do this for 1 year or 2 years. This needs to be 3, 4, 5, 10, 15 years out to sort of recover the expense of getting it up front.
You know, something that I'm glad you said that, John, because I think the only two people I've ever told that it really was definitely not even worth looking at were a couple of people that told me they've had a very, very short-term time horizon.
Yeah.
That they were looking for, 8, 10, 12 months. And I said, it just doesn't make any sense for that. But the other thing I wanted to ask you about is, I hear people talk about the fact, can I lose the property? Can I go into foreclosure? We talked about foreclosures a little bit earlier in the broadcast.
Yeah.
Can we lose our house? Can someone come and just kick us out?
The only way that could happen is just like it is if you don't have a mortgage or you have a regular forward mortgage. If you don't pay your property taxes and you don't pay your property taxes for a number of years, the state of California can come in, or the county can come and take your property away. The other way is if you don't pay your insurance. So you need to maintain property taxes and insurance, and probably do a little bit of basic maintenance of the property. Now, I don't know about you, Ron. I've never heard of anyone, a lender, coming and inspecting a property, but never say never. So the most important thing is pay your property taxes. You're responsible for it still, and keep up your homeowner's insurance.
It's always kind of fascinated me, because in every FHA loan, other than the reverse mortgage, you have to have property taxes are impounded.
Yeah.
Can we deal with that in the reverse mortgage world?
You can, and it's not called impounds. It's called a LESA, LESA, life expectancy set aside. So the government knows when we're all going to die. They say, okay, you're 62, John. You're going to die when you're 85. Therefore, we're going to set aside your reverse mortgage. We're going to set aside 13 years worth of taxes, and you can do that. So assuming you have enough room in your reverse mortgage, you can opt to have the lender set aside the money to pay your property taxes and insurance.
Interesting. Okay. Now, I'm going to throw this one at you just to get your opinion on it. I know it's not for everybody. Your answer is not going to deal with everybody.
Sure.
But nothing does. All of us that are of age right now to deal with a reverse mortgage or to consider a reverse mortgage lived through the double-digit interest rate world.
Mm-hmm.
What are your thoughts about fixed rate mortgages, fixed rate reverse versus adjustable rate reverse?
Yeah, great. So thank you. So the market currently, I don't even know the numbers. I think it might be like 98% of all reverses are adjustable versus the fixed. Now, the fixed rate mortgage is used when someone simply wants to pay off the existing mortgage. They don't want any additional access to money. They just simply want to eliminate the payment and kind of be done. The adjustable one provides a lot of other options. It provides a growing line of credit. It provides the ability to make payments and still have access back to that payment. What do I mean? Going back to my $150,000 story before, once you put that $150,000 in the mortgage, the next day it's available to you again. You could literally pull it back out that exact same year. So the flexibility of the adjustable loan is what's important, why most people end up going down that road. And this is what I tend to recommend to most people.
Yeah, and so the only time I think, when I did the real big jumbo, we ended up doing that one as a fixed rate. But I just did another one just recently that was an adjustable, just for the exact tax planning strategies that you just articulated. Because it just, again, it's all about the individual and the strategy that they're looking for. Now, I know a lot of folks look at these and say, okay, can I get this and rent my house out, being that I have no payment, and get some extra cash flow? Does that work?
You could do it, but you'd be in trouble after a while. So the requirement of the mortgage is it's a primary residence. It's where you live the majority of the time. So that's the definition. If you're out of the home for more than 12 months, technically speaking, the loan is called due and payable. There are a few minor exceptions to that. The most important thing is that you communicate with your lender. So yeah, you got to live in the home. You can't rent it out on a full-time basis. Okay.
That's another interesting one right there. The other thing that you started to talk about, and Josh is just waving at me, so I'm going to have to table this, but I need a real quick answer, and then maybe I can get you to come back and talk about this later. But can I use a reverse mortgage? I want to sell my house in Orange County and I want to move out to the Coachella Valley.
Yeah.
Can I buy it? Can I buy a house with a reverse mortgage? Or is it just something that I've got to own the house free and clear?
No, absolutely. You can buy a home with a reverse mortgage. using the example I kind of gave you before, let's say you bought an $800,000 home in the Coachella Valley, and you put down, $600,000, right? You're borrowing 25% of the home value. You can do that on a reverse mortgage and keep your cash.
Okay, so we're gonna have you come back and explain how we do all that kind of stuff. And does it take a long time? Is it hard? Is there more paperwork? Only about another 20 questions I might have for you. But I really appreciate you coming in and sharing your expertise, John. I know that there's a lot of questions about the product. We're all getting older, or at least we hope to. And we're all looking for ways of maximizing our retirement and our golden years. So appreciate your sharing.